what if you backed out the price effects of the speculators? Where would the metal be clearing? And thirdly, then we say, okay, that's the current conditions. But if we really want to get any insight as to where the price of gold or anything else for that matter is likely to be in a year or more, then you have to look at macroeconomics, because supply and demand conditions can change. And to that point, I think a lot of the dealers will tell you that as of November, a lot of things were on back order. Retail demand was through the roof. That's not the case anymore. And it turned, as these things often do, it turned on a dime.
Yeah, just to underscore what you were just referring to there, Andy Schechtman, the CEO of Miles Franklin Precious Metals, whom I interview every week on our channel for the weekly market update, was talking to us through September and October and November of the unprecedented high premiums that were prevailing all the way from the mints through the major distributors and so on in the retail market, as well as difficulty obtaining retail product, as well as increasingly, record high retail demand for investable product, but not just at the retail level, also at the exchanges and off-taking from ETFs and sovereign central banks accumulating gold at record levels, as well as major buyers that are not typically in the normal retail market, like sovereign wealth funds and family offices and things like that. Can you tell us about that demand picture as you've seen it?
Well, I was going to say that's one of the fallacies that we identify. We call it the famous buyer fallacy. Oh, the gold ETF, GLD, is buying gold. Or this sovereign wealth fund is buying gold, or this central bank is buying gold. And the flip side is these 172,000 gold investors dumped their gold. So who's right? Is it the 172,000 people who dumped it, or the one famous buyer who bought in large measure? And without knowing anything further, you really can't, there's no information value to be gleaned out of that whatsoever. Number one, all of the gold ever mined in 5,000 years of human history is still in human hands. And so these changes that we're talking about of some central bank buys, as in the case of Ireland, a few tons, or even if China buys 1,000 tons, represents a really small corner of a really large cube of gold. Number one, and so it's a small change at the margin. Number two, it just means that gold is sloshing around the pool from one side to the other. It tells you nothing about the overall level of the pool, the value of that pool priced in irredeemable currency units like dollars or anything else. The first thing you'd want to know is, did that famous buyer set a bid and then sellers dumped on that bid, or were the sellers in a stronger position and they set an offer and the famous buyer lifted that offer in the process of buying? That's the first thing you'd want to know. But even then, okay, who's right? I mean, there's a presumption that, the Irish central bank is smarter than 172,000 retail investors. Is that true? I don't know. Sometimes they are, sometimes they're not. And so I wouldn't try to read too much into these things. These are I call them factoids. It's not untrue that Ireland bought gold, but it's a factoid in that it isn't. It doesn't necessarily have the information value that people ascribe to it.
What other fallacies do you focus on in the beginning of your report?
Changes in so-called supply and demand, so changes in mine supply, electronics or jewelry demand at the margin. Again, gold has been held as a money balance for thousands of years, and these small changes at the margin don't really amount to anything. For that matter, changes in the Fed's balance sheet, changes in interest rates, real interest rates, nominal interest rates. If I may, I go off on my rant every time the topic of nominal or real interest rates comes up. And my rant is this: the actual rate at which actual lenders actually lend actual dollars to actual borrowers is dismissed with an airy wave of the hand as, well, that's nominal rate. But we separately calculate a consumer price index, which even the people who are proponents of this theory can't really agree as to what things should go into that consumer price index or what weights they should be given. But somehow we come up with a consumer price index, and then we calculate the rate of change of the consumer price index. We subtract that rate of change from the nominal interest rate to come up with a real interest rate at which no transactions are actually being done. So regardless of whether you look at nominal rates, real rates, Fed balance sheet, quantity of money, M0, M1, M2, whatever, you find that over long periods of time, there really is not a good correlation to the price of gold. There just isn't. You can debate the theory as to why. People that get PhDs in economics get all into, it's kind of the debate of how many angels can dance on the head of a pin. But the fact is, they don't really correlate. And so people look at a lot of these factoids, and the mainstream press and, of course, the gold and alternative asset universe, supply and demand. There's a lot of demand for these factoids, and there's a lot of sources of supply of these factoids. People publishing all this stuff, and everybody gets wrapped around the axle about this and that. But at the end of the day, that's not it's not helpful. And people who trade on this stuff sometimes make money, money being dollars in this context. Kind of ironic. They're using money, which is gold, to bet and make, dollars. But sometimes they make dollars on their bets for the wrong reasons. It's an idea that Keynes introduced. Keynes was largely almost perfectly wrong on everything, but he had one or two interesting insights. And one of them is the idea of what he called this beauty contest, which has come to be called the Keynesian beauty contest. Imagine if the newspaper published a picture of 100 beautiful women and said, I want you to write down the numbers of all these women in the descending order of who's the most beautiful. And whoever picks the most beautiful one, will get whatever, in those days, $10,000 prize, which is a lot of money in those days. And what he talks about is that you're not trying to say who's actually objectively prettier. You're trying to outguess everyone else who's in the contest, and they're trying to outguess everyone else. So you're trying to figure out what the average person thinks that the average person will think is the prettiest. And so I think that mental framework explains a lot of the churn of markets. The Fed says something, and then suddenly the price of wheat shoots up, 30% that day. Usually it's back down within a week, but people who successfully picked up on that hint and understood what the mainstream, trading theory is, can make a lot of money on that bet. And then as long as they're smart enough to get out, as long as they don't think it's durable, they realize it's just going to be a blip. Get in, get out. Take, of that 30% move, take 20 of those percents and be happy and move on, and don't be greedy. And there's an awful lot of that goes on in the market, including the gold market.